Wonderful. Then I would love to welcome everyone. My name is Hala Henderson, and I am the Public Policy and Research Director at the Minnesota Council of Nonprofits. At MCN, we represent over 2,100 nonprofits across the state, and we work to inform, promote, connect, and strengthen individual nonprofits in the nonprofit sector. This event is in partnership between the Minnesota Council of Nonprofits and DEED, the Department of Employment and Economic Development, which is an agency within our state government. We are so excited to be able to provide an opportunity to learn more about paid family and medical leave. And I just want to note, while this event is open to all types of employers, we are creating space to answer questions specifically for nonprofits. The purpose of this session is to answer questions about the implementation of the paid leave program and to prepare employers for January 1, not to debate the legislation that created it. We have over 1,700 folks who have signed up for this webinar, and I speak for all of us when I say we're really looking forward to the discussion with the DEED team. And I am going to turn it over to Linda Miller.
Hi, everyone. Thanks for being here. And thank you, Hala. Thank you to the Minnesota Council on Nonprofits for being our partner for today's webinar. As Hala said, my name is Linda, and I'll be helping to facilitate today's webinar. It looks like we have over 1,000 folks already on the line with us today. So thank you so much for being here. We've got a lot of information for you today. During today's presentation, we're going to begin with an overview of the paid leave program. We'll talk through steps employers can take now to prepare for January 1st, and we'll reserve the remaining time to answer your questions. We also have a lot of information on our website, info.paidleave.mn.gov, including frequently asked questions and an employer toolkit, and we continually update those and other sections of the site. The slides for today's webinar are on the Paid Leave website on our public events page under the About Us tab, and we will also throw that link in the chat. Today's webinar will be recorded for training purposes, and should we decide at a later date to make the recording public, we'll post a link to that on our website and notify all of you who registered for today's event when it's available. Additionally, we send out regular updates about paid leave via email, and you can subscribe to that newsletter on our website. By the way, my team member Julie is putting all these links in the chat, and she will continue to do that throughout the presentation. So we're going to start off with about a 45-minute presentation from Greg Norfleet, who's the director of the paid leave program, followed by a Q&A session. And for that Q&A session, you can submit your questions to us using the chat button. You'll find that chat button at the top of your screen. It's a purple speech button with a question mark on it. There are two tabs within the chat, a featured tab and a My Questions tab. Check the featured tab to see announcements from our team and the links that we mentioned throughout the presentation. Use the My Questions tab to ask a question at any time during the presentation. Only you and the webinar team can see your question. Likewise, other attendees will only see their questions. Our team behind the scenes is going to be reviewing and moderating the questions for the Q&A session and surfacing those that have probably the broadest appeal. With such a large audience, we're well over 1,100 now. We may not get to all of your questions, but please do ask them anyway. We keep track of all the questions, and we use them to inform our outreach and update the FAQs on our website. And if we don't get to your question, know that the Paid Leave Contact Center is standing by, ready to help you. Just reach out to them by calling 651-556-5777 Monday through Friday, and they're open 8 a.m. to 4 p.m. All right, that is enough for me. It's time for the presentation, and I'm turning it over to you, Greg.
Thanks, Linda, and thanks to the Minnesota Council of Nonprofits for helping set up this presentation today. As Linda mentioned, we have nearly 1,200 folks on the line right now, and those 1,200 folks, thank you for taking the time to prepare for paid leave. We are 66 days away until paid leave is a reality for the state of Minnesota, and over the last 2 years, we've been working with partners across the state to try to make the program as strong as it can be for the people of Minnesota, both employers and employees. As Linda mentioned, today's presentation is separated into 3 parts. First, we're going to give you a general overview of the law. What is paid leave? Second, we're going to give you 3 steps that you can take as an employer right now to get ready for the program going live in January. And then third, we're going to preview a little bit of what the experience is going to look like for employers on January 1st when the program goes live. And then we'll also have time for questions and answers as well, so that we can solve some of the issues that you all are dealing with as you get ready to launch this program. So let's just jump straight in. First, we'll talk about generally what paid leave is. Paid leave was passed in the 2023 legislative session, and what it did is it created a paid family and medical leave insurance program that's going to offer benefits to Minnesota employees beginning on January 1st of next year. There's 2 major parts of this law. The law provides both employment protections and partial wage payments that are made to individuals during a qualified leave of absence. We are an insurance program, and much like private insurance, we're funded by premiums. Those premiums are split up between contributions from employees and employers. We'll talk about how that split works a little later in the presentation as well. One of the big things to remember about paid leave, and comparing it to other programs like Earned Sick and Safe Time, is that when an individual is out on paid leave under this program, those payments are coming directly from the state to the individual while they are out on leave, rather than coming directly from the employer. This slide is the program on a page. Paid leave is also called paid family and medical leave. And there's 2 lines of coverage: medical leave and family leave. Medical leave is exactly what it sounds like. It's time off to care for yourself when you have a serious healthcare condition that requires you to be away from work for an appreciable amount of time. In fact, under our program, in order to qualify for medical leave, the underlying qualifying event needs to last at least 7 days, and in all situations needs to be certified by a healthcare provider working within their own scope of practice. So that's medical leave. It's time to care for yourself. Family leave is a little bit broader. It includes time off to welcome a new child into your home, whether through birth, foster care, or adoption. Time to care for a family member with their own serious healthcare condition, as well as providing support to survivors of domestic violence and sexual assault, and to members of our military during an active duty deployment, whether domestically or abroad. Under the program, applicants will be eligible for up to 12 weeks of medical leave or 12 weeks of family leave within a benefit year. A benefit year is an insurance term that just means 52 weeks starting on the date of first absence. So from the first day that you take leave under the program, in the next 52 weeks, you're eligible for up to 12 weeks of medical leave or 12 weeks of family leave. There are situations where an individual may qualify for both family and medical leave during that benefit year. The most common situation is when a person gives birth, they may need medical leave to recover from the pregnancy, and that medical leave could be taken for either prenatal or postnatal care. So those first weeks would fit under the medical leave bucket. However, that parent would then be able to transition into bonding leave to welcome that child into their home. In those situations where a person is taking both family and medical leave during the course of a benefit year, the individual is limited to 20 weeks in total between the 2 types of coverage. So that's what the program is. Let's talk a little bit about who's covered under paid leave. Our program is extremely broad in its coverage. It includes nearly all Minnesota employees and all Minnesota employers, even those that aren't required to participate in other state or federal programs like Earned Sick and Safe Time, the Unemployment Insurance Division's program, or FMLA. Our program includes full-time, part-time, temporary, interns. Regardless of how much or how little you work for a Minnesota employer, if you're performing services and receiving wages for those services, you are more likely than not covered under the paid leave program, even if you're not required to participate in a different program like unemployment insurance. So employees of religious organizations that may not be required to participate in unemployment insurance, nevertheless are required to participate in the paid leave program. The only exceptions really are for independent contractors, self-employed individuals, and tribal nations. These groups are not required to participate in the program. However, they'll be given the opportunity to opt into coverage if they choose to do so. Additionally, we are a state-funded program. All of our funding comes from the state of Minnesota, so we are not able to offer coverage to federal government employees or their instrumentalities, such as the American Red Cross. Additionally, groups like the railroad workers who are covered under the Railroad Workers Unemployment Trust are not able to participate in the paid leave program either. Then there's a small but meaningful exception to coverage that is only for certain designated seasonal hospitality workers that can be designated as not having to participate in the program. However, this exclusion is extremely narrow. In order to qualify under this exclusion, an employee or an employer needs to meet 3 tests. First, the employment needs to be done in hospitality. Hospitality is a defined term under a statute, and it applies to a limited set of businesses. For the most part, those are businesses that either offer food or a place to sleep. If you are on that list of businesses that's considered hospitality, then test number 2 is whether or not your business is seasonal in nature. In order to be seasonal, this is a test of your gross receipts. If you receive 2/3 of your gross receipts in any 6 months of the year, then your business would be considered seasonal. So if your business is both in hospitality and seasonal, then employees that work less than 150 days you can apply to designate them as seasonal hospitality employees who are not required to participate in the program. However, all 3 of those tests have to be true. Seasonal, in hospitality, and the person can work a maximum of 150 days during the year. If you find yourself in that situation, you can apply to designate those employees as seasonal using the unemployment insurance system, and we have some additional resources available on our website explaining this process as well. So, as we mentioned, our program is very broad in coverage, but one question that we often get is what happens if I have employees that work in multiple states? If you're in a border community, you may have employees that split time between Minnesota and one of our bordering states. The way that you determine whether or not an individual is covered by paid leave is it's based off of where they are physically performing their work. If you're working in a single state for more than 50% of the time, your work is localized to that state. And if that state is Minnesota, then you would be covered under the paid leave law. Now, this has implications for things like remote work. Even if you're working for a business that's located in Wisconsin, if you're performing your services remotely from the state of Minnesota, you would be covered under the paid leave law. Now, the opposite of that is also true. If you are working for a Minnesota employer, but are performing your work remotely from Wisconsin more than half of the time, you would not be covered by the paid leave law because your work would be localized to that other state. For the most part, employers can determine whether or not somebody is covered under the paid leave law based off of where they spend the majority of their time working, as long as it's at least 50% of their time. But there are situations where an employee may spend time in more than 2 states during the year. In that case, if they don't spend 50% or more of their time in any particular state, then and only then does it matter where the individual lives. So if you're spending 1/3 of your time in Iowa, 1/3 of your time in South Dakota, and 1/3 of your time in Minnesota, but you live in Minnesota, then you would be covered under the law. However, if you lived in one of the other states, you would not be covered under the law. I know this can be kind of a tricky concept, so we have a few scenarios just to kind of help folks see how this test can be applied in real world situations. In the first, you're a business that's located in Minnesota, but some of your employees live in Wisconsin, and you're asking whether or not they're covered. In that case, you actually don't have enough information to know. Because again, it doesn't matter where your business is physically located, nor does it matter where your employees live in most situations. It depends on where they're physically performing their work. So if your business is located in Minnesota and they're performing services within the state of Minnesota, they would be covered, even if they live in Wisconsin. But if they were performing their work remotely, they may not be. Okay, the second scenario. My business is located in Wisconsin, but some of my employees work full-time in Minnesota or work remotely full-time in Minnesota. Are they covered? In this case, you do know enough because they're physically working in the state of Minnesota, even though the employer themselves is located in a different state. Because the work is physically happening in the state of Minnesota, those individuals will be covered under the paid leave program. And our last scenario, I work in multiple states, but I live in Minnesota. Am I covered? Well, this depends on two separate tests. First, are you spending more than 50% or more of your time in any particular state? If the answer is yes, and that state is Minnesota, you would be covered under the law, even if you're spending 25% in two other states. However, if you're not spending 50% or more of your time in Minnesota or any other state, then and only then does it matter that you live in the state of Minnesota. So if you're not working a majority of your time in any particular state, but you live in Minnesota, you would be covered under the law. So that's who's covered under the program. Let's talk a little bit about what it means to be covered under the program. I mentioned there's two parts of the program: employment protections and partial wage replacements. Now, the employment protection provisions under our law are chiefly administered by the Department of Labor and Industry. A lot of these provisions will feel familiar to employers that are covered under programs like FMLA. However, one big difference between our program and FMLA is that these employment protections apply to all businesses, regardless of size. Among the job protections that are available is the right to restoration of your previous position. Generally, if you take a leave under our program, the employee needs to be reinstated to the same position or an equivalent position that is, quote, virtually identical to the position that they had prior to taking their leave. Another big difference between our program and FMLA is that our job protection, these job restoration provisions take effect 90 days after the date of hire, and that's 90 calendar days from the date of hire, unlike FMLA that has a minimum threshold of hours that you need to have worked before those provisions kick in. Additionally, employers are required to continue to fund group and healthcare insurance premiums at the same rate that they were funding them prior to the employee going out on leave. That means that if you are splitting premiums with your employees, you need to continue to fund the employer's portion of group and health insurance benefits at the same rate that you were paying before they started their leave. This often leads to questions about how do I collect that employee portion of the healthcare premium? And we've seen it done in a variety of ways. Some employers request an employee to write them a check prior to going out on leave in order to cover their portion of the premiums. Others wait until the employee comes back and require them to fund the premiums after they return from leave. We've seen other employers that offer what are called supplemental benefits, which we'll talk about in a bit, where they're providing additional payments to an employee while they're out on leave, and then using that as a base for deductions for healthcare premiums. And last, we've also seen employers that through a conversation with their employee prior to going out on leave, gain consent to pre-fund these benefits before the employee goes out on leave in order to maintain tax advantage status of those deductions. The last thing I'll flag on the employment protections portion is that employers are not able to retaliate or interfere with anyone trying to access benefits under the paid leave program. And that includes interfering with their ability to apply for benefits for the paid leave program. These provisions kick in when an individual takes any action in good faith under the statute. And that could be as little as telling you that that they are anticipating needing leave under the paid leave program. So that's the employment protections portion. That's the leave part. One other thing to mention is that when an individual is out on leave, they can take this in one of two schedules. They can either take the leave in one big block of time, or they can take it in small, which is called continuous leave, or they can take it in smaller blocks of time over a longer time period, which is called intermittent leave. We typically get a number of questions about intermittent leave schedules, and we will talk about how to prepare for your business for intermittent leave in the next section of the presentation as well. So that's the leave part of paid leave. Let's talk a bit about the paid part of paid leave. One major difference between our program and other programs like pregnancy, parental leave, or the Federal Family and Medical Leave Act is that when an individual goes out on a qualified absence, they will be paid a portion of their salary while they recover. These partial wage replacements are paid directly by the state and are based off of your wages prior to going out on leave. These payments are determined on a progressive scale, which means that those who make less get a higher percentage of their income replaced while they're out on a qualified leave, which is important because that allows folks that don't make as much to be able to afford to be able to take this leave and not have to choose between financial stability and being there for the people that they love. Our program awards benefits on a scale where wages between 0 and 50% of the statewide are replaced at 90%. Wages between 51 and 100% of the statewide are replaced at 66%. And then wages above that threshold are replaced at 55%, up to a maximum benefit that's tied to the statewide average weekly wage, which will be $1,423 per week when we go live in January. For folks where that math may not be intuitive, we do have a calculator available on our website so that you can see what the benefit would look like for you if you qualified for partial wage replacements while you're out on a qualified leave. In order to qualify for these partial wage replacements, there's an earnings threshold. Applicants must have earned at least 5.3% of the statewide average annual wage in the previous 4 completed quarters in order to be eligible. That means they must have earned at least $3,900 prior to applying for benefits. Now that $3,900 is a fairly low threshold to entry, but it also does not need to come only from a single employer. Your financial eligibility is determined based off of all of the wages that you've earned in the base period, which is the previous 4 completed quarters. If you've had more than one employer during that time, all of those wages count towards establishing financial eligibility. So if you've had 2 employers, all of those wages count. We often get a question around employers that have an employee where they're only going to earn a limited amount of money from them during their employment. For example, they may only intend to pay a person $1,000 for the entirety of their employment. Those wages are still subject to premiums, and they also do count towards that individual's financial eligibility because if they have other employers, all of those wages will be aggregated to see if they meet the $3,900 threshold. Now, if you qualify for partial wage replacements while you're out on a leave, but you're receiving payments from unemployment insurance, workers' compensation, or Social Security disability during an absence, you're not eligible to receive paid leave payments at the same time. We'll be asking applicants whether or not they're receiving payments from any of these programs during the application process. We'll also share that information with their employer, and we'll be checking our own administrative data to ensure that folks aren't getting paid from more than one program at the same time. These benefits, much like private insurance, are funded through premiums. Premiums are shared between an employer and an employee, and when we go live, for most employers, the premium rate will be 0.88% of wages. And that 0.88% of wages will cover both family and medical leave. That percentage is applied on all wages up to the Social Security cap, which will be $184,000 when we go live in January. These premiums can be collected on wages paid between January 1st and the end of March and should be submitted to the department by April 30th of next year for the first quarter, and then they'll be collected every 3 months thereafter. Now, I mentioned that this premium rate is split between an employee portion and an employer portion. An employer is able to deduct up to 0.44% of wages in order to fund the employee's portion of the premium, which would mean that for most employers, they're required to pay 0.44% of wages themselves in order to fund their portion of the premiums. Now, for small employers, it's an even better deal. Small employers pay a reduced premium. Their effective rate is 0.66% of wages. And for these employers, they're still able to deduct up to 0.44% of employee wages in order to fund the employee portion of the premium. So the reduction is really on what the employer is required to pay to fund their portion of the premium. In order to qualify for this reduced premium, that's going to be based off of wage detail reports. And in order to qualify, an employer must have 30 or fewer employees, and their average employee needs to make less than 150% of the statewide average annual wage, which is about $107,000. If you fit into this criteria, we're going to use the wage detail reports submitted from last October to the reports that are due on Friday for the previous quarter of wage detail reports to establish whether you fit the definition of a small employer. And then in the November timeframe, we will notify you of your status as either a large or a small employer, and we will set your premium rate accordingly. Another way that we're supporting small employers is through the Small Employer Assistance Grants Program. Starting on the same day that benefits go live on January 1st, funding is going to be available for small employers during an employee's absence. If you qualify as a small employer using the same definition that we just walked through, you could be eligible for up to $3,000 in grant funding to hire temporary workers, increase your existing workers' pay to cover for an employee while they're out on leave, or additional employment-related costs, such as training workers to cover for an employee while they are out on leave. An employer can get up to $3,000 per leave, and there's a cap of $6,000 available per employer per year under this program. One last area that we want to touch base on is taxes. The IRS recently issued guidance on the tax treatment of both paid leave premiums and benefit payments. So according to the IRS guidance, these premiums are to be collected on post-tax wages, and anything that an employer contributes is tax deductible as part of the premium calculation. The employer, if they pay their required premium, that can be deducted as an excise tax. If they choose to pick up a portion or all of the employee's portion of the premium, that can be deducted as an ordinary and necessary business expense. At the end of the year, employers should report the amount of any employee-sponsored contribution or the amount of any employer pickup in box 14 of the W-2 and label that as MNPFML. Now, regardless of if you're a large employer or a small employer, this should account for 0.44% of an employee's wages. Should be reported in box 14 and labeled as MNPFML. So that's the premium side. On the benefit side, the IRS issued guidance that basically says that the paid leave program should be treated as a third-party payer. Now, in those relationships that exist in the private market today, family leave benefits are considered income, but they are not considered wages. As a result, at the end of the year, for any employee that applies and receives benefits for bonding leave, caring leave, military leave, or safety leave, the department will issue those employees a 1099 directly at the end of the year. That is a tax reporting form that will come directly from the department to the individual who claimed benefits. Medical leave benefits are a little bit more complicated. According to the IRS guidance, a portion of the medical leave payment made by the state and needs to be considered wages under third-party sick pay rules. This means that they are subject to Social Security and Medicaid taxes. For large employers, this percentage is 50% of any medical leave payment. It should be considered wages, and for small employers, it's 33%. And that amount should be reported as wages on a W-2. Now, much like our program, Social Security and Medicare require an employee portion of a contribution and an employer portion of a contribution. We will automatically deduct and transmit payment to the IRS for any medical leave payment or to cover the employee portion of those taxes. However, because we are not an employer, the employer does have a liability to complete their portion or to submit their portion of those taxes. We're going to support employers by making this information easily accessible in the Leave Administrator portal under the program, and will notify you whenever a payment is made to a qualified employee. Now, there's a lot more resources that we have available on taxes than we're going to go through today, including a handy 2-page document that walks through the basics of what tax administration looks like alongside the paid leave program, as well as a video available on our website that walks through the IRS guidance in some detail. So that is what the program is at a high level. Let's talk a little bit about getting your business ready for January 1st. There's 3 steps that you should be taking as an employer. First, set up your accounts with the division and make sure that you're ready to interact with us on day 1. Step 2, notify your employees about the program. We'll talk about the requirements there shortly. And number 3, there are a number of different decisions that you can make as an employer that can help customize paid leave to work specifically for your business. So let's walk through those one at a time. So step 1, under our program, you're going to need 2 accounts, an employer account and a Leave Administrator account. The employer account is something that most folks on the phone today already have. Some of the earliest feedback that we received from employers was that they were concerned about redundant reporting requirements associated with participating in the paid leave program. We heard that loud and clear, and as a result, we worked directly with the Unemployment Insurance Division to create a process by which most employers didn't need to do anything at all in order to be set up with an employer account on day one. The way that we did this is we took your existing unemployment insurance account and converted it into a joint paid leave UI account. So now when you complete your regular quarterly wage detail reporting with the Unemployment Insurance Division, that information is shared directly with the Paid Leave Division to meet your reporting requirements. Starting next year, this is also where you'll submit premiums in order to fund the program. We did mention earlier that the paid leave program is broader in coverage than the unemployment insurance program, and there are businesses and individuals that are not required to participate in the unemployment insurance program, but are nevertheless required to participate in the paid leave program. For those individuals, we've set up what's called a paid leave only account. You're able to set that up by visiting uimn.org and going through the registration flow. By signing up with a paid leave only account, you'll share information only with the paid leave division and will not enroll in UI benefits. This account has been live since late last year, and we're thrilled that over 3 million employees are having their wages reported each quarter to the paid leave division already. We've been adding additional functionality into the employer account since then, which includes the ability to designate those seasonal employees if you fit into that criteria. And importantly, it's also where you're able to designate a paid leave administrator. Now, if there's one thing that we want to leave you with today as the most important thing that you can do to get ready for January 1st, it's to designate a paid leave administrator within your business. Because the paid leave administrator is the person who's going to have access to your administrator account. The administrator account is something that we've been building over the last 2 years with employers from across the state of Minnesota, trying to understand what information is most helpful to them to help manage when an employee is out on a leave under the program. What we heard from employers is that they value transparency and actionable information. So by creating an account on paidleave.mn.gov, your business will have access to be able to review applications that have been submitted to the division, be able to track when an individual is out on leave, when they're going to return, as well as be able to coordinate benefit payments to an individual while they are out on leave. And this is also where, if you choose to offer these benefits yourself, rather than going through the state plan, then you'd be able to submit an equivalent plan substitution request. This account is live today, and we're thrilled with the number of folks that have already set up an account. But if you haven't done so, this is the most important step that you can take today to get ready for January 1st. So after you've done that, you set up your 2 accounts, your employer account, and your leave administrator account. Now it's time to think about notifying your employees about the law. There are 2 notification requirements under the statute. The first is to display a workforce poster in English and any language spoken by 5 or more employees or independent contractors. This probably feels familiar. There's similar requirements under a lot of programs like Earn Sick and Save Time or FMLA. This poster is available in English, Spanish, Somali, Hmong, and French on our website today. We're adding additional languages as well. So you can download this for free off of our website, and we'll also put a link to that resource in the chat. If you're an employer that's offering an equivalent plan, we've also drafted a poster specifically for you so that your employees have all the information that they need in order to be notified about the program before we go live. So that's the first requirement, is hanging our poster in a conspicuous place. The second is that you need to notify your workforce individually within 30 days of hire or 30 days before premium collection begins. For program launch, that means that by December 1st of this year, you need to notify your employees in English or their primary or preferred language about the program before premium collection starts on January 1st. So that December 1st timeline is coming up, but we've prepared some resources to help you get there as well. We've created a templated notice on our website that's available for download that includes all of the information that you need to provide to your employees in order to be compliant with the statute. That resource is available for download, but we'll also include it in the chat today. One thing to note is that you need to have employees affirmatively acknowledge receipt of the notice. So within our templated notice, there's a checkbox with a signature line so that an employee can say that they have acknowledged receipt of the notice. If an employee refuses to acknowledge receipt, then you do need to be able to document how you attempted to notify your workforce. This is important for you to do because if the situation comes up after the program has gone live, where an employee tells us that they had not been notified about the program and therefore didn't apply on time, then that kicks off fact finding within the division. And the quickest way to make us go away is to show us that you have this acknowledged receipt of the information that they're required to be told before the program goes live. Okay, so at this point, you've set up your employer account, you've set up your leave administrator account, you've hung our poster, and you've notified your workforce. With that, congratulations, you are compliant with the paid leave law. That's all that you need to do in order to be in compliance for January 1st. But there's still likely some work that you will want to do because there are a number of decisions that an employer can make that can help customize paid leave to make sure that it works specifically for your business. Let's walk through a few of those. We're going to talk a bit about how you can adjust premiums for how this works between you and your employees, how you think about coordinating paid leave with other paid or unpaid benefits that an employee may be eligible for during the course of their absence, and some helpful hints on workforce policies that you can develop that are enforceable under the paid leave law as well. So starting off, we talked about the premiums being split between an employee portion and an employer portion. By default, an employer can deduct up to 0.44% of the premium from employees in order to fund their portion of the premium. However, that's a maximum. An employer may choose for competitive reasons or through collective bargaining to offer more than to pay more than their required minimum contribution. You could do this for some or all of your employees. So you may offer senior management to pay the entire premium for senior management, but require other parts of your business to split the premium equally. But it's a decision that you as an employer can make, whether you want to charge your employees less than what is required under the statute. One note is that if you choose to offer these benefits yourself using an equivalent plan, that regardless of the cost of that equivalent plan, you cannot charge employees more than what they would pay under the state plan, which means that you cannot deduct more than 0.44% of wages in order to fund their portion of the contribution, even if your plan costs something higher than 0.88. Regardless of how you decide to do this, once you decide what your premium contribution is going to be, you should set up your payroll system and make sure that you are set up to start taking deductions in order to fund the premium on wages paid after January 1st of this year. We have some tools available to employers and employees so that they can look at the costs and the benefits of the program prior to it going live. We have two calculators to highlight for you, a premiums calculator and a payments calculator. Using these calculators, you can test to see not only what the premium rate or what this would look like coming out of your check in order to fund the premiums, but also what you would be eligible for if you had a qualifying event. As an example, for somebody that's earning $70,000 a year, for just under $6 a week in coverage to fund the benefit, you'd be eligible for over $1,000 in benefit payments if you had a qualifying event. The next major decision point for employers is to think about how paid leave will work with other benefits that you may offer an employee while they are out on leave. We know that employees may be jointly eligible for other payments while they're out on a qualifying event. For employers, the important concept to know here is that almost any payment that you make to an individual while they're on a qualified leave fits in one of two buckets. It's either a supplemental payment or a substitute payment. If it's a supplemental payment, you can use it to make up the difference between partial and full wage replacement. So if I had an employee that was eligible for 50% wage replacement from the division, I could designate their paid time off, sick time, vacation time as a supplemental benefit. And for the cost of half of a PTO day, they could receive full wage replacement from the division, or between the division's payment and the payment from the employer. Now, it's up to the employer as to whether or not they're going to offer supplemental benefit payments. If the employer chooses not to offer supplemental benefit payments, then that same individual that qualified for 50% wage replacement from the division instead would get their entire payment from the employer if they choose to use their paid time off, sick time, or vacation time. It would be received instead of receiving a benefit from the division. So one thing for employers to think about today is whether or not you want to allow your employees to top off their benefit payment using their paid time off, vacation, or sick time, or salary continuation through a program like a maternity leave program in order to make them whole while they're out on leave. We have a few scenarios to walk through to kind of help employers think through this process. So say you're an employer that already has an existing maternity leave program or a paternity leave program, parental leave program, that offers 6 weeks of full wage replacement after a parent gives birth. Can you still do that? Yes, you can. And if you're leveraging supplemental benefits, it actually may be cheaper than what you're currently offering. While you're responsible for currently funding 6 weeks of full wage replacement for that employee, if you designate those payments as a supplemental benefit instead, then we will subsidize a portion of the payment made to that individual while they are out on leave at an extremely low cost in order to fund that portion of their payment. Say you want to offer senior managers full wage replacement while they're out on leave, but you don't want to do that for hourly staff. Are you able to do that? Yes. As an employer, you can set policies within your business to determine who qualifies for being able to use supplemental benefits, whether that's some or all of your employees. Third, can we require employees to use their paid time off so that they get full wage replacement? Now, this kind of relates to how this works under FMLA, where an employer can require an employee to exhaust their personal time off during a leave of absence. However, under our program, this is explicitly prohibited. So you can offer employees the ability to take supplemental benefits, but it's up to the employee whether or not they use their personal time off, sick, or vacation time. So the employers are not able to require employees to exhaust their existing time. Then last, what happens if an employee wants to take a full day of PTO during their leave? During, say, they want to receive 4 days of benefits from the division, but every Friday they want to take a full PTO day. Can they do that? They can. And depending on the way that you structure your benefits, this could either be a supplemental payment where we only pay the difference between partial and full wage, or you only pay the difference between partial and full wage replacement, or it could be a substitute payment where the employee is only receiving that payment from the business itself. Now, not all benefits that an employee is eligible for are necessarily paid. And it's important for employers today to clarify with employees how different programs will work together with paid leave during a qualified absence. There's two programs specifically that we should call out here. FMLA and the Pregnancy and Parental Leave Act are both referenced in our statute. These are both programs that offer up to 12 weeks of unpaid job-protected leave for conditions that would also qualify for leaves under the paid leave program. For employers, for absences starting after January 1st of next year, employers are able to require that if an employee takes leave under FMLA or PPL or paid leave on a condition that qualifies under one or another one of those programs, to run the time concurrently. Meaning that if you have an employee that's out on an FMLA leave and then wants to take paid leave, that time can count towards both programs at the during the same absence. Here's a visual of how this could work. If you have an employee that is receiving PTO for the first 2 weeks, say they said they were going to be out on FMLA, it was a small absence that was only going the last 2 weeks, and then something changed, and now they need to be out for the full 12. During those first 2 weeks where they received PTO, even though they had not applied yet to the paid leave division, those first 2 weeks count towards the individual's overall leave allotment. So the state would only pay from weeks 3 through 12, but weeks 1 and 2 would count towards the 12 weeks available under family or medical leave as part of the individual's overall leave allotment. So the last thing that we'll flag for employers in order to get ready for January 1st is that you can enforce a number of workplace policies in order to make sure that paid leave works specifically for your business. These include that employers are able to require employees to comply with their usual and customary leave notice requirements, unless the employee's leave prevents them from being able to do so. In all cases, leaves start with a conversation between an employer and an employee. It's within our statute that the employee needs to provide the employer notice either 30 days before the start of leave or as soon as practicable. In all cases, as soon as practicable means that the conversation happens first between the employer and the employee prior to the individual applying for leave with the division. Now, an employer has the discretion to be able to say how this conversation needs to occur. That means that they could require an employee to call a certain number, to schedule a meeting with a particular person, or send an email to a specific inbox. Whatever policy works for your business, you should document it, and you're able to enforce that employees utilize that notice process when they're going to request a leave under the paid leave program. Now, we mentioned intermittent leave earlier. To remind folks, leave can be taken in one of two schedules. It can either be taken in one block of time or in smaller blocks of time over a longer time period. That second scenario is called intermittent leave. Under the program, the employer has the discretion to be able to say how big that block of time is. So an employer, depending on what works for their business, can require employees to take leave in 15-minute increments, full hour increments, 4-hour increments, or even full days, depending on what works best for your business. I will flag that that does need to be aligned with how you're managing other absences, but it does allow the employer some degree of flexibility to say how long an individual or what's the minimum amount of time that an individual needs to be away when they claim intermittent leave. The last thing that we'll flag is that employers are required to offer at least 480 hours of intermittent leave each year. If an employee requires more than 480 hours of leave during the year and taken intermittently, after you reach that threshold, the employer has the discretion to decide whether or not the employee continues to take the leave intermittently, or the employer can require at that time for the remainder of the leave to be taken continuously. This is another good thing to put into your employee handbooks and to set a policy today prior to January 1st. So with all of that, you should be ready for January 1st. But let's give you a bit of preview what that is actually going to look like. So when paid leave begins, the most important thing that you can do is to make sure that you have that leave administrator account set up for your business, because that's what's really going to keep your organization in the loop when employees apply for leave with the program. The leave administrator is a person, or it could be multiple people within your business that have a direct line to the paid leave division. This administrator is able to manage your account with the division, coordinate paid leave with other benefits. They'll have access to applications as they come in and are submitted by employees, as well as determination notices and payment amounts, as well as when an employee is on intermittent leave, they'll be notified whenever that employee reports hours. Additionally, if you choose to offer these benefits yourself, instead of going through the state plan, you'll need somebody designated as a leave administrator to submit the equivalent plan submission. And if you're a small business, you'll also have access to that small employer assistance funding through the leave administrator portal. When an employee applies for leave under the program, like we said, in every scenario, that starts with a conversation between an employee and an employer about the intention to take leave. We will ask on every application whether or not this conversation has taken place, if so, when and how. And we'll share that information directly back with the employer as well. After that conversation takes place, the employee can submit an application to the division, either over the phone or online. After the employee submits their application, the paid leave administrator is notified and is asked to review the application. They're given 7 days to complete a request for information. However, if the leave administrator is in the loop early, they can review that application as soon as, I think it's 10 minutes after the application is submitted. And if you do so, then the application will be reviewed immediately by the team within the paid leave division. So the quickest way to an approval is to make sure that your employer is in the loop prior to submitting an application to the division. After the leave administrator submits their review, the paid leave division makes a decision on whether or not this has been approved or denied. And when that decision is made, both the employer and the paid leave administrator are notified of that decision. Here's what it looks like in real life. Through the paid leave administrator portal, each time that an application is submitted, you'll get an email to check, and we'll provide information about the person who's requesting the leave, whether or not this is how they told us that they notified you. If you choose to, if the information is right, you can click yes. You can also tell us whether or not you would like to file a dispute based off of the information provided. We'll provide the dates for which the individual is requesting, the schedule, as well as the type of leave. You can tell us if anything is different from your records as well. We'll also ask whether or not an employee is planning to receive paid time off instead of receiving a payment from the division, and if so, for what days and what amounts. And then we'll also ask whether or not you're planning to offer supplemental benefits during the course of the leave. If you choose yes, we'll ask you to make sure that that amount does not exceed their normal salary, and we'll provide tools to you to make sure that you know how much you can pay your employee during the course of the leave to avoid an overpayment. This is just a preview of what's available in the Leave Administrator portal. This also has a dashboard available for every application that's been submitted to the division, as well as information on any payment made to an applicant or to one of your employees by the division, and the information in order to keep you in compliance with that tax guidance from the IRS that we talked through earlier. We'll provide the amount that you need to pay to fund the employer portion of all of those premiums there as well. And finally, it will also serve as a place when an employee is on intermittent leave, the hours that they report, they're required to report hours every week, and the leave administrator will be notified of those hours as well as any payments made in those situations as well. A lot of this work over the last 2 years has really been an incredible privilege to work on. And we're really excited about being able to offer paid leave benefits to the state of Minnesota in just 66 days. A big part of the way that we've approached this implementation is being open to feedback and listening to folks to understand different perspectives in how to make paid leave work for everyone. We've held over 300 engagement sessions with a variety of stakeholders from across the state, and we've gathered answers, or we've gathered questions and input in order to make the program stronger over time. We've been conducting user research interviews to gain feedback on everything from leave administration to safety leave certification. We've learned a ton from employers along the way. We've been engaging with employers big and small from across the state for over 2 years now. And based off of those conversations, that's why we launched Wage Detail in a system that employers already know and trust with the Unemployment Insurance Divisions program. This is where our rules came in to support the implementation of the statute. And for folks that want to offer these benefits themselves instead of going through the state plan, we worked with the Department of Commerce based off of guidance from employers to create a viable market for equivalent plans if that's the direction they want to go. And importantly, the Leave Administrator portal that we just gave you a bit of a preview of, that is based almost entirely on feedback from Minnesota employers about the information, the transparency and actionable information that they need in order to make paid leave work specifically for their business. We're launching in 66 days, but that's not going to be the end of the conversation. We want to stay in touch with you and we want to stay engaged. Part of our commitment to the state of Minnesota is that we want to continuously improve the paid leave program to make it the best program that it can be. And your partnership and expertise is what's going to make that happen. There's a variety of ways to stay in touch with us. One of the best resources is checking our website, info.paidleave.mn.gov. And there you'll be able to review the 3 steps that we walked through today to make sure that your business is ready for January 1st, as well as reviewing frequently asked questions that in order to estimate premiums and payments are available on the website as well as some detailed instructions to be able to set up both your employer account and your leave administrator account. You can sign up to receive our newsletter where we publish breaking news within the division, as well as helpful tips on how to get ready for the program going live. And you can also send us questions through the website. We take questions either through email or over the phone. We have a contact center that's available from 8 a.m. to 4 p.m. daily. And that number is 651-556-7777. So I want to thank you all for taking the time today. And now I think we are going to transition into some questions and answers. So Linda, I'm coming back to you.
Thanks so much, Greg. We're going to transition over to our Q&A session. Remember, if we don't get to your question, as Greg said, know that our contact center is ready to help you out either by phone or by email. We're going to start off by answering some of the questions that were submitted in advance by participants, and then we'll open it up to audience questions that are with us here live right now. All right, Greg, the first question is, how does paid leave work for an employee who had a baby in 2025? Will they be able to take another 12 weeks of bonding leave in 2026 and have that be paid under the paid leave program?
So there's a couple of things to know here. So our program is going live on January 1st, 2026. Leaves taken before that date cannot reduce the amount of leave that's available to an individual starting on January 1st of next year. Now, bonding leave is a unique type of leave because it can be taken any time within the first year of welcoming a child into your home. So parents that welcome a child into their home in 2025 will be eligible to take paid leave starting on January 1st, as long as the leave ends prior to the 1-year anniversary of welcoming that child into your home.
Just kind of a related question, Greg. What about medical leave? So if an employee goes out in 2025 on a qualified medical leave, can they take medical leave in 2026 for the same medical event?
So it's a really similar situation, but there is a difference when you're dealing with medical leave between 25 and 26. So just like before, leaves taken in 2025 cannot be used to reduce the amount of leaves available to someone when the program goes live in 2026. However, in order to qualify for a medical leave under the program, an employee needs to have the leave certified by a healthcare provider working within their scope of practice that says that they need the additional time.
All right, thanks for clarifying that. Are owners who do not report wages to unemployment insurance covered by paid leave?
Okay, so we mentioned that paid leave is broader than the unemployment insurance division. So even folks that aren't required to participate in the unemployment insurance division's program are typically required to participate in paid leave. For owners, this really comes down to the way that you pay yourself. So if you're organized in, say, an S Corp, where you're required to pay yourself a reasonable salary as part of your corporate governance structure, in those cases, those wages that you're paying yourself as a salary would be considered wages under the program and would need to be reported for premiums purposes. So you would be potentially covered under the paid leave program.
All right, this question comes from an employer who has a number of W-2 contractors on staff. They want to know if they are required to provide job protection to W-2 contractors.
I'm not familiar with the phrase W-2 contractor. So I will say that the definition for a self-employed individual or an independent contractor relies on other parts of Minnesota statutes. If an individual is an independent contractor, which is typically paid through a 1099, then they would not be required to participate in the program. However, if they're receiving wages, which is typically what someone who is receiving a W-2 receives, then they would very likely be covered under the paid leave program.
All right, thanks for clarifying that. This is a question also about who's covered. Are casual employees, and basically I get the idea casual employers are people who just work a few hours, maybe under the, a year. The question is, do we start deducting premiums once we know that that employee has met the income threshold? I think this is a reference to the earnings threshold to receive payments, which is 5.3% of the statewide average annual wage. Or do they start deducting premiums right away? So I guess the question is, do they wait until an employee has reached the $3,900 minimum, earnings threshold before they start deducting premiums? Or do they start deducting them on January 1st?
Yeah, so we get different flavors of this question a lot. And so the two things are different. Liability in order to be liable to pay into the program versus financial eligibility to receive benefits from the program are distinct concepts. Now, if you are performing services for wages within the state of Minnesota, there is no minimum earnings threshold in order to be liable for payments for the premium portion or for the premiums. So even if you only have an employee that's working, say, for $1,000 or $500 during the year for you, all of those wages are subject to premiums. However, it is also worth noting that the wages that you pay to that individual are aggregated against all of the other wages that they earn during the year, which could help them qualify for financial eligibility for benefit payments as well.
Okay, so just to recap that there is no minimum number of hours worked before someone needs to pay premiums, or if you're an employer, collect premiums. The earnings threshold is across all employment. And so we need all employers to report someone's wages and deduct premiums, because we're going to look at all of those jobs and determining and those earnings to determine eligibility.
Correct.
All right, we've got a few questions about sort of the timing of processing applications. So when someone files a claim for benefits or an application for benefits, how quickly will employers be notified about how much is paid to the employee?
Okay, so let's go through a couple of timelines. So from the time that somebody submits an application for benefits, our goal is to turn applications around in 2 weeks. Now, that includes a 7-day period where we're waiting for an employer to respond to that request for information. So the sooner that the employer responds to that request for information, the sooner that a decision can be made on the application. So the quickest way to an approval is to make sure that you and your employer are on the same page prior to submitting an application with the division. Now, after an approval, payments are paid after day 8 of an absence. If you're applying before your leave begins, then on day 8 of your absence, we'll start processing a payment. We'll also notify the employer of the amount of that payment as soon as that payment is processed. Begins processing, it'll show up in the Leave Administrator portal. If you are already out on leave when you apply, if you've already passed day 8 of your absence, we'll attempt to make a payment almost immediately after the approval is there. With that said, as soon as an approval is made on an application as well, that will include both the wages that we use to determine eligibility and the benefit amount that we're planning on paying that individual on a weekly basis.
All right, thanks, Greg. How will employers who plan to offer supplemental benefits, how will they know how much to pay employees to make up that difference between partial and full wage replacement?
Yeah, so it's kind of connected to that. So within the Leave Administrator portal, you'll have access to determination notices. Those determination notices, the approval for an application, will include the amounts that we're paying the individual while they're out on leave, which then you can use to determine what's the difference between that and what they normally make.
All right. Can you talk a little bit about how the state will handle overpayment? For example, if an employer might handle that, if an employee receives PTO, if they accidentally, are paid more than their pre-leave wages, what are some of the options for getting that money returned to handling the overpayment?
Yeah, okay. So in the scenario where, say, an employee took a week of PTO while they were waiting for an adjudication decision from the division, there's a couple of ways that this can be dealt with. The first is that the statute gives both the employer and the division the ability to recover against overpayments. Now, an employer will need to abide by all existing payroll laws in order to recoup any payment made to an employee, which typically means that they'll need the consent of the employee in order to recover those funds. If the employee does not provide that consent, then the division will issue an overpayment notice and then recover those overpayments in line with the requirements in the statute.
All right, we've gotten a number of questions from employers who want to know a little bit more about the determination for small employer to receive the small employer discount. So can you talk a little bit about how that will be calculated? How will the division calculate the employees for that small business premium and grant eligibility? And is that based on 2025 numbers? This particular employer said that they're at 28 employees, but they might hit 31 in this coming January. So they're seeking some clarity about how it will be determined. And then
Sure.
Another question we've been getting a lot of is how will employers be notified and when about whether they fall into the small or the large employer premium bucket?
Okay, sure. So small employer test, to remind folks, is that the employer has 30 or fewer employees and their average employee makes less than about $107,000 a year. That calculation is performed on the previous, so it's performed on wage detail reports submitted between October and October of each year. So from the one that we're going to be doing very soon is based off of the wage detail reports that were submitted since October 31st, 2024, and the wage detail reports that are due on Friday. Now, it's an annual calculation. So if you are a small employer, then you're a small employer through the entire calendar year and won't have your rate changed until the next calendar year if you go above that threshold. But it is based off of the maximum number of individuals that appear on a single wage detail report. So if you have any quarter in which you have more than 30 employees, then you would not be a small employer under the statute. You would need to have 30 or fewer employees in all 4 quarters in order to qualify. Now, we'll notify folks based off of when wage detail reports are submitted here on Friday. We're going to do that calculation and we're going to send employers mail. So you'll receive a notification in the mail that includes a premium notice. And that premium notice will tell you whether or not you are a small employer or a large employer under the statute.
Great. Just a related question. When calculating that total number of employees, are we just looking at the employees of a company that work and meet that Minnesota employee test, or is this for basically like a company that has employees working in multiple states? Will we be looking at their total workforce and deciding whether they're a small employer or not?
Yeah, this is based off of your Minnesota workforce. So it's off of folks that appear on, that have their wages reported to the paid leave division as part of your reporting requirements.
All right, we're just going to ask a couple more of the pre-submitted questions and then jump in and start answering some of the questions. You all have been very patient and submitted them here. We have a couple of questions about the notification here. One is, can the notice to employees and that electronic acknowledgement of receipt, can that be done through a payroll provider like QuickBooks or something like that?
You know, we've seen different ways that employers are planning on doing this. If you're able to, that is something that actually the state of Massachusetts did when they launched their paid leave program, is they put it as part of their payroll reporting process. As long as you have a traceable acknowledgement that the individual was notified about the program, that'll suffice. Whether that's delivered electronically or physically, doesn't matter.
All right, one more question from our pre-submitted list here. For the unemployment wages that if an employer is submitting their wages to unemployment, it includes things like fringe benefits, like an automobile allowance or other wages like bonuses. Is that also true for paid leave and the way paid leave payments are calculated on earnings?
Yes, it is. Paid leave shares the same definition of wages as the unemployment insurance division. So anything that counts as wages for unemployment insurance counts as wages for paid leave.
All right, we've got a lot of questions here. We'll get to as many as we can in the next 10 minutes. All right, jumping right in. Do employees get a quote review period where they're not penalized for, say, a certain period of time while their claim is being reviewed? So imagine they have to go out on leave suddenly and their claim has not been processed. I think they're just wanting to know how that will be dealt with, and will they be, will it be approved in, say, in retrospect?
Okay, so there's a few things to consider here, and some of it is going to be case dependent, so fact dependent on the situation that you're dealing with. Employees that are acting in good faith do have the anti-retaliation and anti-interference provisions associated with their application. So you couldn't discipline a person for requesting benefits from the paid leave division in good faith. Now, if an employee, the standard for an application is that you can apply up to 60 days in advance of going out on a leave. And we anticipate that most applications will come in prior to the employee going out. However, there are situations where an employee learns of the need for leave and doesn't have 60 days before in order to notify the employer and us about the need for leave. They may need to start taking leave effective immediately. In those cases, the employee is still required to tell their employer first, but we're able to backdate an application by 1 week automatically. So without any issue, we can backdate a application 1 week to meet the date of first absence. But if there are circumstances that prevented an employee from going out or from applying to us, whether they were not informed or they were incapacitated and unable to submit an application for benefits, we also have the discretion to be able to backdate further, but we would require documentation showing why it wasn't possible for the applicant to apply timely.
All right, great. So if an employee is acting in good faith in their application with the state, then during that period when it's being reviewed, even if it's ultimately denied, they would be protected from any retaliation or interference in that period if they're acting in good faith. That's good to know. Are employers required to continue PTO, paid time off accrual, while an employee is on paid leave, or does that accrual just resume once they return to work?
Yeah, so the only requirement for continuation of benefits within the statute is that health and group insurance continuation. All other benefits like PTO, seniority, or pension accruals, etc., all of those may but are not required to continue to accrue. So that's a policy of the employer that they can make, but the employee is not entitled by default to continue to accrue things like paid time off or seniority.
All right, another kind of notification requirement. How should employees notify employers when they need paid leave? I think you covered this about customary notification policies.
Yeah.
Do you want to just maybe review that?
So employees are required to tell their employer of before applying for leave. The way that they do that is really up to the policies of the employer. If the employer doesn't have a documented policy, then notifying the employer through a reasonable means like sending an email or text message could work. But if the employer has a documented policy for how you're supposed to notify them, you need to follow that policy.
All right, you were talking a little bit there about continuation of health insurance coverage when an employee is on leave. Can you talk a little bit about the options for employers to collect the employee portion of their health benefit premium while the employee is on leave and receiving their wage replacement from the state?
Sure. So we've seen it in a variety of different ways. We've seen some employers that require an employee to write a check in advance of going out on leave to cover their portion of the premium. We've also seen employers that wait until an employee comes back to work in order to recover their portion of the premium. Additionally, if an employer offers supplemental benefits or if an employee uses paid time off during the course of an absence, the employer can use that as a base to make deductions in order to fund that portion of the premium as well. And last, we've also seen employers that because employees are required to have a conversation with them prior to going out on leave, be able to, with their consent, pre-fund the healthcare premiums prior to the employee going out on leave through payroll deductions, which keeps the tax advantage status of those deductions.
All right, we have a question about parents who give birth. And the question is, do birthing parents automatically get 8 weeks of medical leave and then 12 weeks of family bonding leave? Or is the medical leave dependent upon a doctor's recommendation?
Yeah, so in all cases, medical leaves are dependent upon a doctor's recommendation. So depending on the medical portion of that leave, it would be certified by a healthcare provider for the amount of time that you need to be out. Something to flag here that's kind of cool is we are going to be the first state in the country to have a combined flow for birth and bonding leave. So when you're in this situation as a birth giving parent, you can apply for both medical leave and family leave in the same application. But for certification purposes, you'll need to have a healthcare provider sign off on the need for medical leave. And then once the child is welcomed into your home, you can provide the discharge papers or a letter from your physician or the birth certificate if it's available in order to unlock bonding leave payments.
All right, this is kind of on the related subject. So this employer is asking, my employee's daughter is expecting a child in November. Can my employee take family leave to care for her daughter as she recovers from pregnancy and birth? That's the first question.
Okay, so you've got a family member, so an individual has had a child and you're asking whether or not their parent can take caring leave to help them recover from pregnancy?
Actually, it's so the employee's daughter. So she's wanting, so the question is, can the employee take time off to help her daughter, care for her daughter as she's recovering from pregnancy and birth? So the medical side of that, of, the medical leave and then the bonding leave. So I think they're wanting to know their employee is not the person who's having a baby, their daughter is. They want to know, can they take time off to help that person recover? So medical leave, caring leave, yeah.
This would depend upon a variety of factors. It's not a hard no, but in order to qualify for caring leave, the healthcare provider of the individual who's receiving care would need to certify that the care is medically necessary for the individual. You wouldn't be able to access bonding leave if you're not the birth giving parent or non-gestational parent. You would need a healthcare provider that's certifying that the care for that individual is medically necessary and that it has to be provided by that parent. So that's not like a typical situation that we would see, but it would require certification from a healthcare provider that it's medically necessary.
All right. So just to clarify, the employee cannot take bonding leave to bond with her new grandchild. That's reserved just for birthing and non-birthing parents. And in order to take time off to care for her daughter, their daughter's health provider would need to certify the need for that care and that the employee is the one to provide it. All right, I see that Miriam has put up the feedback survey form. We are getting close to time here. So I just want to thank everyone for submitting your questions. I know we didn't get to as many as you probably would hope, but just know you can please submit those to our contact center. And please provide us some feedback on today's webinar. This QR code will take you to a short survey. It'll take about 1 to 2 minutes for you to fill out. It really matters to us to get your feedback so we can continue to improve the information we're providing it and how we're providing it. And again, check out our FAQs, contact our contact center if you need help answering your questions. And with that, I'm going to turn it back to the Minnesota Council on Nonprofits and Bailey Sutter, MCN's Public Policy Manager, for some closing remarks.
Awesome. Thanks so much. Hey, everybody. My name is Bailey Sutter. I'm the Public Policy Manager at the Minnesota Council of Nonprofits. First, we just wanted to thank you so much for joining us today, and thanks to the paid leave team for organizing this really helpful webinar. Event participants will receive an email from the Minnesota Council of Nonprofits, and it'll include resources on paid leave, many of the links that were shared in the chat today, and some others as well that will be helpful. And we highly encourage you to fill out the survey, as stated earlier, because both MCN and the paid leave team really are looking for ways to improve the offerings that we provide the nonprofit community. And so again, thanks so much for your time. We appreciate it, and we hope you have a great rest of your day. Take care, everybody.